Good morning, peoples. Let's jump in here and get Amazon and Amzy. All right, well, there's a lot to catch up on. It's not really that good of news because, as I had suspected, they blew right past their weeklies. Pretty ugly, really ugly, as a matter of fact. Good news, since they had rolled their synthetic, they're making money on the synthetic, but a lot of that money just goes away with the big loss. So let's start with the trade that they did. Well, you never like to see this. You buy something to close for 508, and then you write a new one and you get 101. So let's show you. They sold 42.30. So they sold all these 172.5s. Well, guess what? They got 6,000 of these 170s. They're even further behind on. Maybe they're hoping for a miracle, but this one's pretty ugly. So let's give you the math on here. So something that they collected 544,000, okay, on the previous Friday, on this Thursday, because they wrote it so tight, right? They wrote these 3.33% out of the money. And they lost $5 on something they got less than a dollar, and something that got $1.39. So they received 544. They spent 2 million to buy it back. They received 12,000. They spent 66,000 to buy it back. They received 17,000. They spent 94,000 to buy it back. I call that an ugly, ugly loss. And then they got all of 101. Okay, so I don't know why this is showing out of the money at that amount because that's not correct. Oh, I didn't put the right strike price. They sold it for 182.50. So 6 trading days, they did it again. 2 point. Now, look, I get it. This isn't much money. But if there's not much money, do the right strike price. The heck with the money. If it flies up, the synthetic will take care of it. Ah, so frustrating on these. So they got 427,000. But I mean, this is just ugly. 2 million on something you got $1.39. You had to pay 508. I don't blame him for taking it off the table. This thing could go a lot higher, right, than 177. This thing could be one. So just ugly. I don't know any other way to describe it. So here's the scenario. So they took that one off and they wrote a 182.50. Well, where are we based on the closing price? We got 6 trading days before that one comes, and we're only 2.76. So hopefully, and look at this guy. We're really, if you think the 2 million was ugly, wait till they finish taking this one off, right? So here we are. How does that one look? Well, we collected 909,000, and right now we'd have to pay 4.689. And most of that is no longer time premium with 1 day to go. So this thing would have to go back down $7 to keep the 909,000. Now, some fairness, but again, it's 3 million, 4.5 million, almost 8 million. Well, we're up to 14 million positive on our synthetic. But do you see what I mean? How one wipes the other out? These guys have just been getting killed on these things because it's a procedural mechanized thing with them. They just go in there and they go, okay, we're going to write out a strike price. I mean, a moron could do this. This isn't any particular option skills. I don't see anything here. I just see them grabbing, 1 week out and they go, okay, well, a 182 gets us $1. A 185 only gets us 70 cents. A 190 may give us 30 cents. So let's go for the dollar. Does anybody look at what are the, That's why you have an upside with the synthetic, and this is supposed to be income capturing. But when you take a massive loss, guys, there's no income either. You take it out of the treasuries, which in turn to pay somebody, and then the NAV really goes down. So I just don't get it. I'm really soured on these synthetic. I don't own any AMC, but I'm still angry about it, about what they're doing and what they continue to do. This only works in a moderate up movement, and you need an up movement. So you just wiped out big up movements, slightly down movements, and big down movements, right? Because the big down movements are going to kill your synthetic. You're going to win the weekly no matter whether you write it 1% out or 5% out. But you'll really get NAV decay in that. So where do we close? 1938. Okay, and what's fair value? 1937. All right, so the good news is, look at this. We've gone from 3 million to 7 million to 14 million, but they didn't plan for any of this, right? We had a $17 million loss over there. They planned for a tiny bit here. Otherwise, who would have written such foolish strike prices, right? And then do it again when you got destroyed. I mean, sure, maybe they're figuring, okay, well, it's going to go down now. Well, I don't know. That's all I got to say. All right, let's take a look at the payout. Then, all right, so I don't have to say ugly. Look, guys, because this has already taken away the short call income. I mean, it wasn't that much anyhow. And look what we got killed over here on with the synthetic. Now, the good news is, what do we have? We've got a gain of 14 million. But guess what? If it goes up a lot today and you go, oh, great, the synthetic's going up, we're already capped on one and well over the 170. So it will take dollar for dollar out of that synthetic. There will be no gain. So if it goes up 20 points, we're hosed. It's going to cost us millions and millions and millions in cap. And all of that money is going to eat any synthetic gain. So how do you ever recover? I think they need to rethink, and maybe they do need to do these call spreads or something, because this scenario just isn't working. So that's what I got for you guys. It isn't pleasant. I don't even enjoy doing this when it's just downright awful. I mean, you can't root for a big upside. You really can't. All right, so this is not financial advice. I'm not a financial advisor. This is for fun and entertainment. I hope you were really entertained with a $4.32 loss. All right, guys, have a good one. Bye for now.